Have you ever walked past a grand, imposing bank building and wondered, how do they actually make all their money? It seems like they just hold on to our cash, but the reality is a complex and fascinating financial engine. So, how exactly does a bank turn your deposits into profit? Let's break down the business of banking. The primary way banks generate income is surprisingly simple. It's called the interest spread, or net interest margin. Imagine you deposit your savings into a bank account. The bank pays you a small amount of interest for letting them use your money, let's say around 2%. They don't just let that cash sit in a vault. They turn around and lend it to someone else, a person buying a house, a student funding their education, or a business expanding its operations. For this loan, the bank charges a higher interest rate, for instance, 7%. The difference between the interest they charge the borrower and the interest they pay you. The depositor is their core profit. In this case, that 5% difference is the bank's fundamental revenue earned by acting as a financial middleman. Of course, that's just the beginning. Banks have a wide array of other charges that contribute significantly to their bottom line. Think about the common fees associated with your everyday banking. There are monthly account maintenance fees just for keeping your account open. When you use an ATM that isn't part of your bank's network, you'll likely face a withdrawal fee. If you accidentally spend more money than you have in your account, you'll be hit with a hefty overdraft penalty. And when you apply for a significant loan, like a mortgage, there are often extensive processing and origination fees to cover the administrative work. Each of these small charges, when multiplied by millions of customers, adds up to a substantial stream of income for the bank. Beyond these traditional methods, modern banks have diversified their operations to create even more revenue streams. Credit cards are a huge profit center, while they offer convenience. Any balance you don't pay off at the end of the month starts accumulating high interest, which goes directly to the bank. Many larger banks also offer wealth management and advisory services. Here, financial experts help affluent clients invest their money in stocks, bonds, and other assets, charging a fee or a percentage of the assets they manage. On an even larger scale, major banks engage in investment banking. This high-stakes division helps corporations raise capital by issuing stocks and bonds, advises on mergers and acquisitions, and trades financial securities on the global markets. It's a fast-paced, high-risk, and potentially high-reward part of the business. Finally, banks play a crucial role in the global economy through foreign exchange services. When you travel abroad and exchange your dollars for euros or yen, or when a multinational corporation needs to pay a foreign supplier, the bank facilitates the currency conversion and takes a small commission on every transaction. So, the next time you see that solid bank building, you'll know it's much more than just a place to store money. It's a dynamic institution built on the interest spread from loans, bolstered by a multitude of fees, and expanded through diverse financial services like credit cards, wealth management, and global investment banking. By combining these different income streams, banks not only secure their own profitability, but also play an essential role in keeping the gears of our economy turning, ensuring that money continues to flow where it's needed most.